Everybody, Jason here, Quant News. Today we're going to talk about delta hedging options. Now this sounds like some super complicated thing that only professionals can deal with, and absolutely professionals are doing a lot of hedging, especially delta, but we can do it too. Now theoretically, academically, and probably practically, delta hedging is actually an intraday dynamic process where you're constantly figuring out the delta of your overall stock position, or your options position, and then selling the commensurate number of shares against that position to offset that delta. So what does all that mean? Well, when you trade an option, the price of that option is actually influenced by the change in the underlying price. So you buy your call option on Palantir, the price of the Palantir stock goes up, the price of your call option goes up, and that's measured by delta, right? Mathematically, it's the derivative. It's a partial derivative on a stochastic differential equation, at least in the Black-Scholes framework, where it's the change in the option's price with respect to the change in the underlying. And the first step to hedging that delta is to actually compute the delta. Then you figure out the number of shares that you need to sell if you're long the call, or buy if you're short the call, and then you execute that trade. Now, again, professionally, most professional market makers or options traders will do this dynamically in a way to always be completely or near perfectly hedged in delta. But we as retail traders can do that as well. But we don't need necessarily to do anything massively sophisticated. We can just sell a commensurate number of shares equivalent to our delta for our position. So we're going to look at how to do that today with Python with a really great library called quantlib. Quantlib has been around for a very long time. It's a C++ library that was ported over to Python, and it's got some really great derivatives pricing features. It is a little bit weird to use. You've got a lot of code that you have to implement, but we'll walk through that today. Okay, so let's get started. First, we want to import quantlib, and in our example here, the only thing we need is actually quantlib, and by convention, we'll import it as QL. The next thing we want to do is set today's date. And this is the so-called evaluation date. So today is the 16th of August, 2024. And we'll use ql.settings.instance.evaluation date. So this is kind of what I mean, a lot of code. The next thing we want to do is actually define our option. So let's go out to Yahoo Finance and find an option on Palantir. So first thing we need to do is get the expiration date. So let's look out, I don't know, a couple months and say, we'll get the monthly, October 18th, 2024. So October 18th, 2024. And we'll pick an in the money or at the money strike, let's just say $32 on the call, okay? So 32 and at the call. So now we've basically defined our option. We are evaluating the price as of today, and this is the expiration and strike of that call. The next thing we need to do is actually create the payoff and exercise objects. So this is a plain vanilla payoff for a call option, which is the max value of the stock price minus the strike price, or zero at expiration. And we are going to use a European exercise in this case. Now, Palantir, arguably these are American options, which means you can exercise them at any time prior to expiration. But today we're just going to look at a European exercise for demonstration purposes. And we will then create the vanilla option, i.e. the European option, using the payoff and the exercise objects, which come from quantlib. Okay, so let's now set up our environment. We need to assign the spot price. So Palantir is trading at $32.07, so 32.07. I don't know what the volatility is, but let's say it's 30%, 35 annualized percent. It does not pay a dividend, right? Let's see, summary. Do we have a dividend? Xdiv. Okay, so no dividends. So we will say 0. And we will say the risk-free rate is 5%. I think that's probably about right. I don't know what the Fed funds rate is today, but it doesn't matter. Okay, the next thing we're going to do is actually create these so-called handles, okay? So I'll talk through the code, and then I'll kind of explain conceptually what we're doing. When we're pricing options, the underlying can be various different things. And in our case, we just have a simple quote, a simple single value. You can have barrier options that require different payoffs and have different spot prices. You can have futures, all sorts of different things. But we're just going to wrap the simple quote with our quote handle, and this creates a quote a spot price handle for quant to deal with. Now, the next thing is we have to create a volatility term structure, and the Black-Scholes process assumes a flat term structure, right? So the Black-Scholes framework assumes that we have a single volatility value throughout the life of the option. Now, we know in real life this is not true, hence the whole concept of a volatility term structure, but we will use a black constant of volatility throughout the life of the option. And all of this stuff in here is just the today's date, a calendar, the quote handle that we created, a simple quote for volatility value, and then the fixed 365-day fixed calendar, okay? The same thing is true of the dividend. So we actually have a zero dividend, but we will just assign it anyway. And what this does is it uses the flat forward. So instead of having any sort of term structure on the dividend, it's just assuming a constant dividend rate over the life of the option, and the exact same concept here with the risk-free rate. Okay, so these are the so-called handles or the objects that quantlib needs to actually price the option. Okay, the next thing we want to do is create the so-called Black-Scholes-Merton process, and we do this with the spot handle, the dividend handle, the risk-free handle, the volatility handle. And what this does is it creates the Brownian motion underlying the Black-Scholes framework. So Black-Scholes was novel because it used a stochastic differential equation to describe the motion of future stock price movements, and then it discounted the option value back. And there's a couple different ways to do Black-Scholes. You can do it the analytical method, which is kind of what I just described. And there's also, of course, a closed form solution. As far as the code goes, it's pretty similar. So I just chose to use the analytical solution here. But we need to define the process in any event. So now that we have the process, we can actually price the option. And we'll do that by taking our European option that we defined earlier, set the pricing engine to an analytical European engine, like what I just described, and then pass in the Black-Scholes-Merton process. So under the hood, what this does is it runs this process some large number of times, and it takes the distribution of prices at the end of that process, and it takes the payoff for each of these paths, and then it discounts that all backwards. And that's what we're seeing here. So the net present value of that object. And this will eventually converge to the Black-Scholes-Merton closed form solution. Mathematically, this is the whole quant finance space, but we can assume that this is the correct model price for the option. Let's see what the actual price is in the market. If I go back to, where am I? Options. I said October 32 strike. So the market is pricing this option at, okay, so there's the implied volatility numbers, 50.1%. So let's actually update our volatility. So I underpriced the option. And let's reprice this to see what we get. Okay, so 287. And the bid ask on this is 266, 265. The last traded price was 271 on the 32. So it's not perfect, but it's pretty close. And the reason it's not perfect is because we are assuming a flat volatility curve, whereas the options market it has a more sophisticated view on volatility, number one. And number two, it's because we are assuming a European option, and this is very likely an American option, which allows exercising at any point in time. So that will probably account for the price difference, but pretty close for our purposes here. Okay, so now that we've got the price, we can compute the delta. So when I compute the delta, I get 0.56. So what does this mean? Crudely, this means that for every $1 the stock price goes up, the options price will go up by 56 cents. Now, I say crudely because, in fact, it's delta plus gamma squared is how a stock price moves relative to, an options price moves relative to a stock price in the Black-Scholes framework. You can see this in the Black-Scholes stochastic differential equation, which I will not show you. But point is, it's a good or pretty close approximation of what you might expect an option price to change for every dollar of change in the stock price. And this is what we care about. So we care about hedging this value, which means if the stock price goes up, our options position will be neutralized by our short position in the stock. Said another way, we want a portfolio of one option and some number of short shares such that if the stock price went up $1, our option price would go up 56 cents, but our stock position would go down. We would lose $56 on the stock position. Now, why does this make sense? Well, every options contract is essentially representing 100 shares. So if your option price goes up 56 cents, the dollar P&L that you actually earn there is 56 cents times 100 shares, or $56. So you can see here that if our option value goes up 56 bucks and our stock price value goes down 56 bucks, we have a neutral position relative to delta. Okay, so how do we compute this? Very easily, we just multiply our delta times our spot price, which is, so that tells me that our initial option or stock position is 18 shares. So we need to be short 18 shares such that if the price of the stock, if Palantir goes up $1 and we're short 18 shares, we have lost $18, but we have neutralized our delta position, okay? All right, so now that we've established that, let's assume that the price of Palantir goes up to say 30, let's say 33. Let's say spot price plus $1 and see this in action. Spot price plus $1. Okay, so now the stock price has gone up $1, right? So we set the initial spot price at $32.37. Let's say CARP comes out and says that Palantir invented nuclear fusion, and now Palantir's stock price went up $1. So you can see that the option price actually went up quite a bit more than our delta. And this is relative to that gamma term I said. So this is kind of what I mean by we don't have a perfect hedge here. We're only losing $18 on the stock price, and we are making, 13 cents, $59 on the option, but that's actually pretty close to our delta, okay? And my point being, though, is that if we have our $3.46 minus $2.87, that's 58.9 cents, right? That's pretty close to our delta. The difference, the 3 cents, is gamma squared, okay? Let's see if we can actually see that. I'm doing this on the fly, so let's see what we see. Gamma. There you go, 5 cents. So if we took delta plus gamma, okay, well, it's not that close, but hopefully you get the point. I think this is actually our new delta, right? Yeah, okay, so I'm sorry, that's our new delta. Yeah, I need to rerun all this to get back to where we were. Okay, so our original delta was 56 cents. Our original gamma, let's just do this here. I'm digressing a bit from my conversation, but I want to try to prove a point here, is 5 cents. So 56 cents plus 0.057 is 61 cents, which is approximately what we're seeing in the difference in the stock price, the option price when the stock price moves, okay? All right, so let me get back to our initial conversation here. And I realized I made a mistake. We don't sell, we just sell delta times 100. We don't sell delta times the stock price. That's what we would earn, okay? So our stock position is minus 56 shares. So we would go short 56 shares to neutralize that option position. That was a typo in the code. What we would earn, or our short position would be worth basically $56, okay? So then when we run this new option price, we get $43.46, right? And what this is telling us is that now that the price of the stock has moved, the option price has moved. So if we were to go up, this is the new option price. This is the old option price. So the price of our option increased by 58 cents as we saw, and that is worth $58. So the value of our options position increased by $58. Now, if we were to be short 56 shares, as we said in our original delta, then we would be 56 shares times $1 per share. We essentially neutralized our gain in the option. And what that is telling us is that now we have exposure to the other components of the option, so volatility or gamma, et cetera. So this is kind of a crude but effective way to hedge against your options delta. And typically you wouldn't necessarily do this with a single option, because if you're just long a call, that's basically just long the underlying. But if you had like a straddle or a strangle, you would compute the delta of that straddle or strangle, and by shorting the shares of delta, meaning that neutralizing that delta, then ultimately you'd be just exposed to the volatility of the underlying. Okay, cool. Thanks for joining. This was just a really quick intro into a great way for retail non-professional investors to actually hedge delta. It doesn't have to be as complicated as it might seem. And if you're trading options, this is a super effective way to really concentrate that exposure into volatility or gamma or even theta, which is the time decay. Join me again. I'll be posting these videos once a week, and it will always be short, to the point Python code that explains how to do various things in quant finance, algorithmic trading, and market data analysis. Take care.